Hi there, welcome to our weekly tax update. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisors. Today is the 9th of October 2019 and we will be talking about landlords, properties and trusts. This is the reason I've chosen this topic for today is because in the last couple of weeks and months I've had a lot of clients who have approached me to set up trusts or who are in the process of setting up trusts for their property portfolio. So it's a very, very important topic as people, as landlords, try to decide what to do with their property or how to pass it on to the next generation or how to protect the family assets. So there are a few things to consider from a tax perspective. And there are a lot of misconceptions about trusts. First thing to realize is that trusts were previously a very good option for properties. However, since the 2006 and subsequent years, the rules have been tightened. And for larger estates, the trusts are somewhat problematic, or should I say prohibitive. The government doesn't want people to set up trusts as they used to before. So the first thing to consider is what happens when you set up a trust. What are the implications? So if we say this is a trust and we've got husband wife transferring properties into a trust, what are the implications? So the first implication that you need to be to think about is inheritance tax. Second one is capital gains tax. Now, inheritance tax applies if the value of the property is more than £325,000 above £325,000 per set law. So if there's two of them, that can be 650. So up to 325,000, or for two people, it's up to £650,000. There is no inheritance tax charge because that's within the exempt amount. The next point to consider is, so if the properties are worth more than 325,000, I see landlords, clients who have properties worth, say, £30 million, £40 million, £60 million, £100 million. And they come to me, oh, Jamal, we want to set up a trust. And I say to them, why? Is because their friends have done so, or because it's very common, or it's fashion. Everybody wants to set up a trust. No, it's not as easy as it used to be before. So somebody they met on the golf course, and he said, oh, I've got a trust, or my granddad had a trust, so I should better set up a trust as well. No, things are different now. Things are very, very different now. So you set up a trust. If it's more than £325,000, if you've got a couple of millions of worth of properties, you're going to have to pay tax at 20% over the value, over the exempt threshold. So this is called a lifetime tax, lifetime charge. Very, very important. So if you've got properties worth £5 million, this could potentially cost you £1 million, roughly £1 million in tax. And the rest you pay the second half of the 20%, which is the total tax is 40% inheritance tax. You pay 20% now, 20% on death, if you die within a certain period. The next tax to consider is capital gains tax. So capital gains tax applies on transferring a property into a trust. However, this capital gains tax can be held over. It's called holdover relief. if inheritance tax applies. So there's a special relief that you need to claim, but once again, even if the property is within the threshold, the exempt threshold, so there's no inheritance tax to pay, you can still hold over a capital gain. So effectively, the holdover relief means that the trust takes over the base cost of the property. So this can be useful mechanism for transferring smaller estates, which I've just done for one of my clients. You transfer a property into a trust for a child, and you can run the trust for, say, 6 months, 3 months, 6 months, and get the property out of a trust to the child without having to pay the tax, because when the property leaves the trust, you can once again claim holdover relief. It can be a very tax efficient mechanism. A lot of people are not aware of this, but property comes into the trust and goes out of the trust, and we claim holdover relief going in, holdover relief going out. So instead of having to transfer a property direct to the children, we use the trust mechanism. So this could be expensive, this could be easy or tax efficient. Very, very important lesson in this one, and if done properly, if all the documents are drafted correctly, it can be very, very beneficial. Now, the next point to consider is the income tax. Once the trust is set up, what happens? So the trustee's responsibilities start. Okay, register with HMRC. Now, for income tax purposes, trusts pay tax at 45%. This is the highest rate of tax, and this is why some of the trusts are very prohibitive, because you start paying tax at 45%. Now, the trusts pay tax at 45%. That's not paid once. You have to make payments on account. So from cash flow perspective, this can be very, very expensive. And I'm having to close down a lot of trusts these days for clients, because the clients just cannot keep up with the 45% payments. Now, if this income is distributed to beneficiaries, the beneficiaries are, say, basic rate taxpayers. They pay tax at 20%. They can get a tax credit. But first, the trust has to pay its tax. The beneficiaries have to claim a tax credit, and it can be very time consuming. But if the beneficiaries are higher rate taxpayers, then the tax credit is almost nil. So you can end up paying a lot of tax. This can be very, very expensive. The next part to consider is capital gains tax. Call it CGT, or capital gains tax. So the trusts pay tax in capital gains tax, same as individuals. They get an annual exemption of half of the annual exemption that individuals get. So trusts get an annual exemption of £66,000. And the rest of the tax rates are roughly similar to what individuals pay. Now, the painful part here with trusts is the tenure charge. Every 10 years, the assets in the trust are valued, and you pay a charge up to 6%. Now, if you've put properties, say £35 million, £20 million in the trust, this can cost you 6%. And for that reason alone, a lot of people are now starting to close down trusts. If you get properties out of the trust, you have to pay something called exit charge. Okay, exit charges depends on how many quarters you've completed between year 0 to year 10. And this, once again, this can be quite expensive. So there are a lot of complications around trusts. As I said, the beneficiaries, and you've got to start funding the 6% charges, the annual income tax charge of 45%. It can be very, very expensive. Now, the question that we have is whether trusts are still worthwhile or not. Is that people should they still be going into trusts or not? So the answer to that depends on, it depends. Answer is, it depends. If it's a small estate, small, I would say 325,000, maybe up to 650, then maybe yes, it's worthwhile. But if it's a large estate, then it can be quite expensive. Depending, there are different types of trusts. There are some trusts that are called trusts, but they're called will trusts. So they only become active when you die, or when somebody dies. And in that case, it doesn't have too much tax. They're not tax efficient as such. But if you're creating a lifetime trust, which is during your life a trust is created, then you have to be very careful. You have to think of all the tax consequences before you set up that trust. So it's best to take specialist advice. You can call us, you can contact us, you can talk to any advisor if they're familiar with the detailed knowledge of trusts. You can contact us. The telephone numbers are on the screen, or you can go to our website. And if you have any questions, you can always contact us. Thank you very much for watching, and hopefully we'll see you next week.